Okay, I think let's start then. So welcome everyone to our webinar on setting up a business, the financial and tax implications. Just to give you a bit of introduction to me, so I'm the finance director at AW UK, so I deal with all the finances and any kind of finance related areas for the company. And I work at Moore Kingston Smith, an accounting firm based in and around London. We have a couple of offices. And I'm a manager in our media office in the West End, deal with a range of clients in the media space and work with companies to assist them on accounts, tax, audit, as well as finance, kind of wider finance areas. So I'm joined today by Michelle, who I'll pass over to so she can introduce herself as well.
Yeah, hello everybody. So I'm Michelle-Denny West, and I'm I suppose part of the entrepreneurial tax team. And what that means is I work with individuals and business owners, whatever stage of the business life cycle, whether it's at this stage, sort of startup, right through to exit and eventual estate planning. So I get involved in all the kinds of taxes and just advising generally. And my involvement in Moore Kingston Smith been with them quite a long time, but I predominantly based in our Romford and City offices, but I also support our West End and media office also. So it's nice to meet you all.
Yeah, great. Thanks, Michelle. So just to say we can't see your faces and we can't see you on the screen. So if you've got any questions, if you could pop them in the chat, we'll try and answer those as we go through or in the questions section at the end. The webinar is recorded, so don't feel like you have to write loads of notes. We can share that with you afterwards for you to kind of go back and have a look at if you want to. So let's move on to the first slide. So setting up a business, kind of what are the options? So there's a number of options available to you. So first one is a sole trader. And this is anyone who does business without taking kind of proactive steps to trade through another structure. So in other words, sole traders are kind of the default business structures for individuals running their own business. And then next one is partnership. So this is similar rules to a sole trader. However, this would be if you're in business with someone else. So you'd have two or more people that you're working with, and that income from that partnership is split between the business partner or business partners, and those profits would be included on your personal tax return as the same with a sole trader. Now then, if we go on to limited company, so this can be run on your own. You don't need another director or partner in the limited company with you. And then you would set up a limited company, also known as incorporating. And this is a business which legally becomes a separate entity to you. So you would hold shares in that business, and you can pay yourself through a couple of different ways, which we'll run through a bit later on. And then you've got limited liability partnerships, which are also known as LLPs, which kind of occupy the middle ground between a partnership and a limited company. And you'd have to have more than one person. So you'd have to be in business with another person or other people in order to set up an LLP. And it's quite a flexible profit allocation between members. So it gives you a bit more flexibility on kind of sharing profits. Now, when it comes to limited company and limited liability partnerships, it's kind of in the name is that you have limited liability. So this is a company or a partnership that's legally separate from the shareholders and directors. So you're not personally liable for any losses made by the business, whereas within a sole trader and partnership, you would be personally liable for those losses. So that's kind of a big thing to think about if you're setting up a business or you've already got a business set up. Okay. So we're going to focus on sole traders and limited companies during the webinar, because those are the two options we see a lot more often. So to go through sole traders is, this is if you're wanting to run your own business as an individual and working for yourself. So you're technically self-employed. So you would invoice companies that you're working with, which will be marked with your name and address. So they are easy to set up. So that's a good kind of pro in relation to sole traders. And the things that you need to do is you need to notify HMRC and register as self-employed. And we've got the link on the slides here, so you'd be able to go onto the government website and set up as self-employed on there. So you've got to think about that you are the business. It's kind of part of kind of you, and there's no limited liability. So any business debt that you have, any business losses, is your personal debt. And as mentioned before, self-employed, you're not employed by anyone, so you're working for yourself. Setup costs are and running costs are low, so you're required to keep records, but it's not as onerous as if you had a limited company. So you'd have to keep an analysis of any income that you've had in the year and any expenses as well. And normally we'd recommend doing that on an Excel document and keeping copies of invoices and expenses in relation to the business. So it's a good kind of minimal admin and filings compared to a limited company. So in regards to being a sole trader, so there's various tax aspects you need to be aware of. So once you've informed HMRC of your sole trader status, you need to think about what kind of taxes you need to pay. So you would pay taxes on any profits that you've made in the tax year, and that will be done via your personal tax return. So for example, if you make £100,000 income with £70,000 expenses, you'll have a profit of £30,000 that you'd pay income tax on. Now, you also need to be aware of national insurance costs. So there's two different types if you're a sole trader. The first one is class 2, which is you pay this in order to be to qualify for benefits such as state pension. So it's really important that you're paying the class 2, and that doesn't matter what your profits are, and that's at £3.45 currently a week. And then class 4 comes into effect if you're making profits of over £12,570 a year, and you'd pay class 2 and class 4 then if you hit those profits. And it's a different percentage depending on how big your profits are. So if your profits are between £12,570 and £50,270, then you're at 9%, and anything above the 50,000 is at 2%. Next, you need to think about your filing of the tax return. So because it's your business is yourself, you're doing your personal tax return, and the filing deadline for that is 31st of January the following year. So for example, your tax year is to 5th of April 2023. You need to file your tax return by 31st of January 2024. And then we go on to actually paying your taxes. So income tax is payable on the 31st of January and 31st of July each year. So 31st of July, you'd pay kind of a balancing figure of anything you didn't pay in the prior year, and then also your first payment on account for the current year. And then on the 31st of July, you'd be paying your second payment on account for that tax year. And then class 2 and class 4 national insurance contributions. Class 2 is payable on the 31st of January, and class 4 national insurance is payable on 31st of January and 31st of July. So moving on to limited company. So this is completely separate legal entity. The company's money is not your money, and we'll go on to that on one of the myths that we're going to talk about a little bit later. So in regards to setting up a limited company, you would need to incorporate via the Companies House website and choose a name for your company. And there is a very kind of detailed step-to-step guide on how to do that on the government website, and it's really helpful. And then you also need to notify HMRC if you decide to change the legal structure. So you incorporate a company, you'd need to let them know that you've incorporated that company. So as we talked about earlier, limited liability, no, you're not personally liable for any losses made in the business. And the benefits of setting up a company is kind of enhanced business image. It gives a kind of additional kind of professional view. A lot of people know what a company is, and they're widely recognised kind of throughout the UK and overseas as well. So yeah, it's a good option if you want that kind of enhanced business image. However, there is a kind of price to pay in relation to setting up limited companies, which we'll go on to now. Okay. So there is significantly more compliance required for a company. So you'd need to set up a business bank account in the company's name, and you need to keep kind of detailed records. And we'd normally recommend an accounting package. I'm sure quite a lot of you have heard of Xero or QuickBooks. Those are kind of the simpler packages that I think you can get on your mobile phones these days and take pictures of receipts and save those down. So you'd need to think about what accounting package you'd want to use for your company. And then let's go on to the filing requirements. So once you've incorporated, you'll have filing deadlines in relation to accounts, other information, statutory information, as well as tax. And with a limited company, you can choose your year end. So unlike sole traders, you kind of run with the tax year, whereas with a company, you can choose your year end. So a lot of people choose 31st of March if they're kind of running their own company. And it just helps a little bit with tax because it's quite close to the tax year end as well. So first off is the filing of accounts. So you have to file accounts at Companies House every year, and Companies House is a public data, a public website that everyone can go onto and view those company accounts. So that's something to be aware of. And the filing for those is 9 months after the year end, or 21 months from incorporation of a new company. So for example, if your year end is March 2023, you would have to file those accounts at Companies House by 31st of December 2023. And there are other filings required at Companies House. For example, a confirmation statement needs to be filed every year, and this confirms any changes to the company. For example, change of address, shareholders, those people that own the company, and anything else that needs to be that they need to be notified about. And then there's also other documents as well. So for example, if there's a change in directors, you're required to file that kind of as soon as possible at Companies House. Any change in shares as well, you would need to update Companies House, and that would all be on a filing register that you can see at Companies House as well. And then moving on to tax. So all companies pay corporation tax if they're profit making. So you'd need to file a tax return with HMRC in line with your year end. So that's the filing of that is 12 months post year end. So 31st of March 2023 year end, you'll be having to file by 31st of March 2024. And then you also need to think about the payment of that corporation tax. So all profits, so you would need to pay 9 months and 1 day after the year end. So 31st of March 2023 year end again, that will be on the 1st of January 2024. You'd need to pay it on or before that date. Otherwise, you'll have interest payable on the tax balance. So the company pays tax on profits, and then once you take any money out of that company, you would pay personal tax on the amount of money that you take out, depending on, and it would depend what taxes you pay, depending on how you take that money out. So the options for taking money out of a limited company. So if you're a director, you would be employed by the company and you'd be on the payroll. So for a monthly payroll that's paid every month, you would pay PAYE and NIC on the 19th of the month after for the company. And then there is the possibility of doing an annual payroll run as well. So we see that quite a lot if there's a sole director and there's a certain amount that you can be paid through the payroll where you don't hit the NIC contribution threshold, but you're still accruing the benefits for state pension. And that's what we do with quite a lot of kind of single director or a few directors in some of our companies that we help with. And then if you're a shareholder, you have the option to take dividends out of the company, but you can only take dividends up to the value of retained earnings. So retained earnings are a build-up of your profits over the years. So for example, if you've just set up your company and you made a profit after tax of £10,000 for the year, you could take a dividend of £10,000 out, but you wouldn't be able to take any more out of the company because you don't have the reserves available to take that dividend. Now, any dividends that you do take out would go onto your personal tax return and paid in line, a bit like with a sole trader. It would be 31st of January and 31st of July each year. And the owner of a business, so if you're a director and a shareholder, you have the ability to decide how to pay yourself. And this could be salary, dividends, or a mixture of both. And it's worth thinking about the tax implications and the tax savings, which Michelle will go on to now.
Right. So normally when people are setting up a business, the first question I'm asked is, so what is most tax efficient? What should I do to pay the least tax? And if we go back a few years, what it used to be up to a certain profit level. As a sole trader, you're better off. And then you got to say to £100,000 of income, then it'd be moved to a company because that's more tax efficient. Given the way tax rates and everything's changed recently, actually that's not the case anymore. If you're somebody who's going to be looking to extract all of your profits, everything else remaining equal, then actually sole trader is more tax efficient than a company pretty much every time. And again, so these numbers on here are just like an illustration sort of showing, so we take the £100,000 line. As a sole trader, you're probably taking around about 50,000, 55,000 of that home. But in a company, you're taking somewhere between 48 and 54,000. So again, I suppose the question is, why on earth would you even consider using a company if you're going to be paying less tax than a sole trader? The reason is actually if you are looking to retain some of the profits in the company, i.e., let's say you're earning £50,000 a year, you know, you may need that. Or if you're, say, earning £150,000 a year, do you need all of that? If you don't need it all, then actually this is when it's actually a company can become quite effective. So have the next slide, please. Yeah, so with a company, you get a lot of level planning points because, as Jenny's already said, as a sole trader, you are paying tax on all of your profits as they arise. So 31st of January, 31st of July each year, you are paying tax on all those profits, whether or not you spend them or whether or not you keep them in the business. When you've got a company, the company will pay tax on all the profits as they arise, but at a much lower rate than you would do if you're a sole trader. Then, of course, you need to pay tax as you extract the money. But if you're not needing it all, then you can leave the cash in there and actually take it out to take advantage, of lower tax brackets. And just sort of keep it for later. And actually, some people keep enough cash in a business to actually just fund their retirement in later life. So again, it gives you a lot more planning options. So the main planning points are, of course, retaining the funds in the company you just mentioned. Also, pension contributions from a company can be very tax effective because, again, you as an individual don't have to make them personally. The company can make them on your behalf. And actually, pension contributions, provided there's actually a commercial basis to do so, can actually be made on behalf of other individuals. For example, you have a husband and wife sort of situation where you're making pension contributions for them, or even to a certain extent, you know, if there's a commercial reason for your children for doing something for the business, again, it's worth thinking about. More recently as well, electric cars have been a very, very good planning point for those who are operating through a business, because what you can do is structure your remuneration. Again, I won't go into the details of this, such that you're effectively paying very, very little tax on this car that's coming out of the business, and actually you are paying next to nothing, the company's funding it, and overall it just works out you're paying actually not a lot. Whereas if you're operating as a sole trader, the tax implications are very different. You can't do that in quite as an effective way. But again, with the planning points of the company, all really depend on your future plans and intentions and what you're looking to achieve longer term. If you're looking predominantly just for the tax saving now, extracting it all, then a company may not be the best thing for you. However, a company might be the best thing if you're going back to what Jenny was saying earlier, you're looking for that limited liability and want to protect sort of the rest of your assets and things. I mean, another positive with the company in terms of paying less tax is that as a corporate entity, there are more tax reliefs available to you. So for those of you here today, that would either probably the research and development or more likely the creative sector tax reliefs. And these tax reliefs work by essentially ensuring they take your profit, knock a bit off, and you pay a bit less tax. Is essentially how it works. But if you're a new business setting up as well and you're looking for some external investment, again, acting as trading as a corporate entity also allows you possibly to access some reliefs called Enterprise Investment Scheme or Seed Enterprise Investment Scheme reliefs. And these are essentially tax reliefs to people looking to invest in your business. They put money in, they themselves get a tax deduction, and you therefore receive this cash that you can invest and sort of help get your business up and running. I mean, whilst there are a lot of conditions and things that need to be met for this, again, if you're looking for external investment, that can be very, very valuable. There's a lot of people nowadays that are looking to save tax somewhere. But as with anything in the tax world nowadays, it is all very dependent on your individual circumstances. So there is no one size fits all. It used to be a few years ago, we could say, I mean, 100,000 tend to be the trigger point. We'd say, yes, from that point, move from sole trader into limited company and sort of vice versa. But actually, that's just not the case anymore. It's just so dependent on what you're looking to achieve longer term. But and however you're looking to trade, and we'll talk about this a bit later, you need to be aware of the employment status and IR35 legislation, because again, there's a lot of anti-avoidance out there, and you've got a lot of individuals who will try and structure their affairs to ensure that they are taking advantage of sort of lower tax rates, but not necessarily in quite the right way. Firstly, I just wanted to mention the creative sector tax reliefs that are available. I won't go through a slide in detail, but essentially, just so you're aware, there are currently 8 corporation tax reliefs available. The ones highlighted in red are those that are actually changing in the not too distant future. There's a consultation coming out in the summer, I believe, to basically change the rates that apply to these and actually the way the relief is given. But just to be aware, so you've got the film tax relief, animation, high-end television, children's television. That relief is going to be combined into one relief, which is going to be called audio-visual expenditure credit, catchily named, as with most of these reliefs. So it's going to be one single relief, which should simplify the system a bit. And also the video games tax relief is just going to be replaced by a slightly different one. What's worthwhile being, first of all, just be worthwhile being aware that these exist. Again, so you can, they can be very helpful, but there are a lot of conditions that need to be met. So if, as and when, you're operating in business, these might apply, go and speak to your advisor and actually ask the question about, what you need to be doing, whether they think you can apply, is there anything you need to change in terms of record keeping and everything else, just to make sure that it's not paperwork that, that stops you from getting tax reliefs. Again, we see that all too often. And on to the next slide. So I mentioned briefly about employment status. So as Jenny already mentioned, as a self-employed freelancer, you engage with other organisations and you bill for your time. So the money you bring in, your profits, and you pay taxes on them through self-assessment. If you're an employee, however, at your company, tax and national insurance gets deducted at source, you're paying tax a lot earlier. So, and again, it goes back to that point of actually which is the most tax effective for you. So as you can see from this, if you were given anybody in the same situation, given say £100,000 of income, who would end up better off? And running the numbers as a sole trader, again, this is very based on 2 individuals with very similar circumstances. If you had £100,000 of income come in, if you to take it as a salary from a business, you'd take home about 60,000 of that. As a sole trader, you'd like to take home around about 68,000. So again, there's a massive trade savings as a sole trader. As a result, there are a lot of instances where people who are operating as sole traders whilst they might actually be employed by the entity, will arrange their affairs such that they get this sole trader tax rate rather than the employed tax rate. And the reason for this is a national insurance saving, and it predominantly comes from, if you're taking a salary from a business, that your client who is paying you that salary will have to deduct employer's national insurance, and that is largely where the tax saving comes in. And so what we tend to see is you get somebody who is, again, will go to an organisation, essentially be an employee of them, but actually saying, instead of me being an employee, can I just invoice you and you pay me? And this is largely the reason for that. And so obviously HMRC don't like that. If arrangements are put in place where they're contrived to make it so that you are just trying to get this tax benefit, then HMRC will seek to attack that, unfortunately, and try to tax you as an employee. So if we go on to the next slide. So, I mean, why should you care about this in the sort of situation you're in now? And the reason is, it's just because HMRC are getting a lot hotter on this now, particularly when people are starting out as sort of freelancers, contractors, where like an employment relationship can develop over time. You find that you've gone from sole trader into that employment relationship without realising it. HMRC suddenly get very interested. It's worth being aware that these rules aren't new. They've been around for a long, long time. I just think with recent cases coming through the press and just generally, what's going out in the media generally, it's just this is becoming much more prevalent and people become much more aware of this. But obviously, it very much depends on the terms of engagement and the work that you're undertaking in these instances. So there's no necessarily right or wrong answer in quite a lot of the cases. It's very much dependent on your circumstances. And if this comes into question, there'll be a number of main tests that HMRC look at. The first test is the personal service test. So if you can do it yourself, if you have to do all the work yourself, and you're not allowed to provide anybody else, then if HMRC were looking at this test, they'd be like, oh, well, you're probably more likely to be employed rather than self-employed, because if it's requiring you under an employment arrangement, obviously you have to provide the work. Like, Jenni comes to work every day, she has to come and do her job. She can't, come and bring somebody else in to do it for her. However, if you're not available for any reason and you can provide a substitute, whether that's somebody appropriately qualified or somebody else in the industry, then on that particular test, it'd be a leaning towards actually you're probably self-employed. Another test is control. And by control, it means actually who controls what you do, how you do it, where you do it, all that kind of thing. So if you can come and go as you please, make your own hours, do what you like, essentially, again, you're probably more on the self-employed side of things. If, however, it's very structured, you have to follow what all of the employees are doing, then again, you're very much on the other side of the coin and be on the employment side. A big thing that tends to come up as well is this thing called mutuality of obligation. And it's something that HMRC do look at quite a lot. And essentially, mutuality of obligation is the obligation on the employer to provide work and you, the employee, to do the work. So you have to accept that. So let's say you're out there in the workplace, you've engaged a client and they say, okay, I want you to, I don't know, provide some production support on this particular project. Actually, you as a self-employed person, theoretically, should be able to turn around and say, actually, no, I'm not interested. No, thank you. I'll pass on that. Call me again with something else. So again, that probably put you on the self-employed side. If, however, you are obliged to take that work on, they've told you that's what you're doing, and you've got no choice, then you're probably on the employed side. So again, it's about looking at everything on balance. Another of the main tests is being in business on your own account. And what this means is again, if you've got genuine, you'll probably have other projects that are running alongside. They might be short-term, might be long-term. And again, this will be looked at in its entirety as a whole with everything else. But to give some examples is that if you've got one client and you're on a long-term contract, which is annual and it renews every year without fail, HMRC are probably going to look at that and think, well, you might be putting down your tax as being, the sole trader and paying less tax, but actually we think you're employed. We're going to seek to tax you as an employee. On the flip side, if you've got clients that come and go, they're all short-term contracts, then you'd be on the other side. Again, there's no one size fits all for this. It is very much dependent on your circumstances, but just wanted to give you an idea of the kind of thing HMRC will look at. There's also a couple of other tests, which include the provision of your own equipment. So again, if your employer provides all the equipment you need to do your job, then it's likely HMRC will consider that to be an employment relationship and vice, but if you have to provide all your own equipment, could be on the other side. And again, another thing is about taking on the financial risk as well, because there have been some cases more recently where what's happened is an individual has engaged with somebody on a sole trader capacity, but even if they weren't available to do the work, or just didn't turn up to work, the client still had an obligation to pay that individual, and that's very much like an employment relationship. So again, it's about, in that case, you're not taking on the financial risk, you're being paid regardless. So if you become unwell, that's very much an employment relationship. If, however, you're genuinely self-employed, if you don't turn up to work or don't provide anybody, that normally means you don't get paid. So again, it's just that financial risk side of things. The good news is that there is a test on HMRC's website called it's called the CESS test, which can help, if you're not sure where you fall within this, because again, normally what happens is you've got all these tests, they're all conflicting, you're not really sure if you're in employed, self-employed, what should it be? If you go through this test and answer it honestly and actually stick with it, at the end, what it will do, you'll get one of three options. It'll either say you're employed, it'll say you're self-employed, or unfortunately, in too many cases, it just says, we don't know. If you're on one of those two, where it's employed or self-employed, and you're looking to rely on that, if you keep hold of it and print it all out, then HMRC are bound to actually, accept that, provided obviously how you've answered the questions is correct. If, however, you're in that grey area in the middle where it doesn't really know, then unfortunately you're probably having to just make the choice yourself, or actually seek professional advice and get the opinion of a professional advisor, just to kind of make sure that you're kind of just sort of covering your back a little bit on that. Another piece of, I suppose, good news for you guys is that within the film and TV industry, there is a bit more guidance from HMRC's website, because people working in, this industry, it's not uncommon for there to be a lot of freelancers, a lot of sole traders or contractors who are there, you're dipping in and out of different projects, some long-term, some short-term. Sometimes you provide equipment, sometimes you can provide a substitute, sometimes you can't. So, it's like, where on earth do you put yourself there? But the good news is that HMRC do have some employment status manuals, and there are some specific pages which are listed here, which you can go to, and sort of, provided you meet certain conditions, it will give you that guidance as to whether you fall into the employed or self-employed camp. Again, which is just worth mentioning, because not a lot of people are aware that exists. Right, so we've talked about sole traders and those who just work for themselves. So let's move on now to what happens if you decide to work through a company. So you set up a company, and what happens is your company, on this diagram here, the PSC is a personal service company, so that is your company. You work for your own company, not an uncommon sort of arrangement. However, it's the company itself that engages with your client. You as the worker provide all the services to the clients. You're the one who turns up every day and delivers everything that's needed. However, it's the company that holds that contractual relationship, and it's the company that will invoice your client, and your company will then get paid the cash. So again, a lot of these arrangements work very well when you've got somebody working, it is a genuine sort of service company, they've got other clients, and they're just sort of dipping in and out lots of projects, and actually for whatever reason, like the corporate entity is the right thing for them. What we tend to see is, and again, what HMRC tend to see, is that a lot of situations where somebody will set up this arrangement, but actually, whilst they are a worker doing stuff for their client, for all intents and purposes, they're an employee. Understandably, HMRC don't like this, because again, it's all about tax saving. It's the fact that things are being contrived to be set up in such a way so that tax can be saved, and obviously more tax being saved by you means less tax being received by HMRC. Understandably, they don't like that. So in this kind of arrangement, it's worthwhile, you just need to be very careful just to ensure that if your nature of your relationship with your end client seems like an employment relationship, it probably is. It might not be in all cases. That doesn't mean that if you operate in this way, that if you've got several different contracts running with different clients, that doesn't mean all contracts will be treated in the same way. So each one has to be looked at independently. But it's just worthwhile being aware that these rules are here. They are very much anti-avoidance, and this is probably the biggest thing that worries people setting up on their own initially, particularly when they're using a company, because they're worried that HMRC are going to come knock on their door and suddenly charge them lots of tax. And it's just, again, just being aware of these rules before you set out, and just go and take the appropriate advice, or speak to others in your situation just to see how they've dealt with them and look at the guidance around there. But yeah, I mean, it's essentially just there to stop companies from bypassing the PAYE rules and to make sure, that the right amount of tax is paid. And again, it says at the bottom, it's to ensure that an individual doing the work of an employee is taxed as an employee. It's that thing we always call, the duck test. If it looks like a duck, sounds like a duck, it's probably a duck. So with these off-payroll working rules, or IR35 are the most commonly known, again, as with the rules applying to the employment status for sole traders, they're not new. They've been around for a long time. For a long time, though, individuals were expected to police themselves. So you work in your personal service company, you have to decide for each client, am I an employee, am I self-employed, and deal with the relevant sort of tax obligations there. However, most people were either ignoring these rules or doing nothing with them. And HMRC just aren't set up to police them. So more recently, the rules have been changed so that if your end client is a medium or large organisation, again, I won't go into the specific details of what that actually means, but if it is like, quite a sizable organisation, then it's actually your end client who will determine whether you are employed or self-employed under these rules. So they will either deduct PAYE and national insurance, or they'll just pay your company gross. It doesn't matter if you're still engaging through your company, because what we see now is that, companies are effectively being taxed under PAYE, which before these rules was never a thing that existed. So again, it's that the way HMRC are now policing these rules is putting it down to that end engager to say, actually, before it wasn't really impacting you, so you didn't really care. So you were just letting people decide to do what they wanted to do. But now we're going to come and get you if you don't make that, that right call, which is why it's moved that way. As I've mentioned, it only applies to medium and large companies at the moment. Small companies aren't within this, but we do expect in the next 3 to 4 years or so, we think everybody will be within this. So it will move to the end user in each case. But the way this works is that your client, again, assuming they're medium or large, will go through a process to issue what's called an employment status determination. And essentially, that will just say, if you're inside these rules, you'll be taxed as an employee. If you're outside these rules, nothing will change, and your company will continue to receive the money gross, and you deal with corporation tax and extract the money by salary or dividends, as Jenny mentioned earlier. What we've seen in practice is that a lot of the end users, i.e. your clients, are taking a very risk-adverse approach and are applying these rules, even if actually people aren't an employee, because they're so worried about HMRC coming along, tapping them on the shoulder and issuing lots of fines and penalties. As a result, there is a dispute process. So if you've got an engagement with a client and you don't agree that they're taxing you correctly, i.e. they're taxing you as an employee rather than as through your personal service company as receiving the money gross, you can go through this process. But it's quite limited at the moment. But there is a dispute process there, and there are particular time limits and everything else that everyone has to sort of follow in order to sort of follow this. What's worthwhile remembering is if you do fall inside these rules and your personal service company is taxed as if it's an employee, you as the worker aren't an employee of that end client, despite the fact you are effectively being taxed that way. And so it means you don't get any employment rights, there's no holiday pay, there's no pension benefits, there's no statutory sick pay, etc. So again, if you fall within these rules, it's pretty uncomfortable, because you're getting all of the downside and the sort of good side of the, having an employment relationship. So again, it's just worth being aware. So if ever you find yourself in this sort of situation, just make sure you're talking to your advisor and sort of going in with your eyes wide open. If we now move on to small companies, so as mentioned, the previous rules only apply to sort of medium and large companies to a certain extent. So when I say it only applies to large and medium, that just means that it's the end user that dictates that these rules, these off-payroll working rules, or the IR35 are still in place for small companies. The difference is you, the worker, working through your own personal service company, you have to decide whether or not you're employed or self-employed. So again, it seems a bit counterintuitive that you as a small, you're engaging with a smaller entity and you've got to make that determination yourself. But that's just currently how the rules are. So it's difficult, because then it is like, again, it's going back to the old rules. It's your responsibility to assess whether the engagement is that of an employment relationship or otherwise. So, and again, if you're caught by these rules, you end up having to pay tax and national insurance if you're on a deemed employment income. So again, rather than the end user deducting tax and national insurance at source, you within your company would have to do it yourself. And again, there are special rules that apply to do this. Probably they are massively overcomplicated, because again, it's tax. Tax seems to be complicated in this country. Every time we try to simplify something, we complicate something else. So again, it's just worth being aware that if that exists, again, speak to your advisor and sort of get help with this, because it's just not worth getting it wrong, to be perfectly honest. I think that's all that is on that slide. So again, it goes back to the question of, well, how do I know if I'm employed or self-employed under these rules when you're looking at IR35? And essentially, it's very similar to what we talked about earlier for sole traders in terms of looking at what your employment status is. So predominantly, when looking at the IR35 rules, there are 3 particular ones that are looked at. There are more, but these are the main ones. So again, but it's the same as we were talking about earlier. So we've got control. Yeah. So what degree of control does the client have over what, how, when, where, and you complete the work. Again, it goes back to that employment relationship. If you're being told what to do, where to do it, and how to do it, on balance, you lean towards the employee side of things. However, if you've got freedom to come and go as you please, do it on your own timescales, then you're leaning over to the actually being outside of these rules. Substitution is a big one, and this is talking about whether the work that's being done has to be done personally by you. And what that means is that you can't, if you're off sick one day, you couldn't phone up, somebody you worked with previously or somebody from a previous project, say, actually, if you're free, can you stand in for me and do this? And again, this is actually a lot where these cases go to court or HMRC question them. It's this substitution that tends to fall down. And what's worthwhile noting about substitution, it's about the ability to do so quite often, rather than it doesn't necessarily mean you have to actually be doing it. And there's been a lot of controversy with HMRC, in particular recent court cases, where they're saying, well, this has never been actually done. But actually, the courts have come back and said, just because it hasn't been done doesn't mean it can't. So again, it's important to make sure, where possible, that you can send somebody else in your place if needed. And again, it's that mutuality of obligation point where, if your client offers you the work, you're obliged to accept it, versus you can just walk away and pick another project later. Right, I'll talk about the other factors. So again, those are the factors on the previous slide were the main ones, but again, go back to that same point, is if you're a sole trader, net employment or non-employment relationship, if you're using your own personal service company, again, it's about whether or not you and your business and your company are taking any financial risk. So if the company's obliged to pay you whether you turn up or not, you're probably not taking that kind of risk. And again, what we see quite often is, and what HMRC is seeing quite often, is people who actually become part and parcel of the engaged organisation. They get invited to all of the socials. They get included on any sort of internal, team communications. They get invited to the Christmas party, things like that. So if you are effectively being treated as an employee, then again, HMRC will look through that and be like, well, you probably are an employee. And again, it's that important thing about being in business in your own account and also the provision of your own equipment. So again, the more clients you have, the less likely to be seen as an employee, but it's not the only determining factor, because appreciating, given the nature of what you might be doing, it might only be possible to have, one project going at any one time. So again, it's just making sure that these are looked at, as a group rather than just in isolation to each other. So this CESS tool, or check the employment status for tax tool, that's on HMRC's website. Again, it's the same place as for the sole trader one. You just need to make sure you tick a slightly different box, otherwise it'll come back and tell you there's an error and you're doing the wrong tool. But what's important to note for this is that when you go on and start answering these questions, you'll see a disclaimer at the bottom which said, there must be a contract in place between you and the client for you to complete this test. And the reason being is actually a lot of the questions will look at the contractual rights and everything else, and so it's relying on the contract being in place. If there isn't a contract in place, unfortunately, you can still use this tool, but you can't place any reliance on it should HMRC inquire. Another point to mention is that we've talked about the right of substitution. So this tool focuses on this and the questions it asks, but what it does, it hasn't actually factored in the case law results, and certain case laws, when it's gone through the courts, it's been, judged to be one way or the other. Certain cases that go through the courts, will have a bearing on future decisions that HMRC can make. And this, unfortunately, isn't factored into this. So again, it's another thing to be aware of, which is, again, reason why actually the use of this tool is quite limited. But as mentioned previously, provided you've answered the questions correctly and the information you've given actually remains accurate and true, then HMRC will stand by all determinations given by this tool. So if you fill it out and it's stating that, either you're self-employed or, you're deemed sort of like you're not within the IR35 rules, then just please do make sure you keep a copy of that, because we have had instances where people have, you know, come on the right side of this. It comes to an HMRC inquiry, and then they haven't got the proof that this tool gave them the right answer, because they've gone through and answered it again, and now they're getting a different answer. So it's just, yeah, please make sure you do keep copies of that. And again, similar to the self-employed and employed question, you get 3 possible results. You've got the intermediary legislation applies, and that means your company will be taxed as an employee. It doesn't apply, carry on as normal, you know, carry on invoicing your client, receiving the money gross of tax and dealing with it in the company, or, which comes out, unfortunately, seems to be more often than not, unable to determine, which again is then where we should go and sort of seek additional advice, just to make sure you're getting on the right side of that. Right, so what I want to talk about now briefly, so I've probably just overloaded everybody with information, as seems to be the way of a tax person. But I just wanted to mention some of the more recent cases that have gone through the courts, just to give a bit of context for, yeah, just where people have either got this wrong, where HMRC are looking, and kind of how it's not quite as black and white as it all might seem. So earlier this year, we had Stuart Barnes, you know, as a former rugby player, who went through the court process with HMRC. So in his case, they all agreed that mutuality of obligation was present, i.e. he, you know, if Sky offered the work, he had to take it, you know, and they were paying him a fixed fee in return, you know, so he was providing it all personally, you know, so that's a tick in the, you know, the employment box. They also agreed that control was present. So, you know, basically if Stuart Barnes was called upon Sky to do some work for them, he had to give them the first right of refusal. So again, that's indicative of an employment relationship. So those 2 points weren't in, you know, in contention at all. So just looking at those 2 in isolation, you'd be definitely, you know, employed. And that's what he would be. However, there were a couple of other points, which is actually where the Stuart Barnes case went in his favour, was that he was actually in business of his own account, because he worked for a lot of other broadcasters and, you know, had other clients on his books. And also he had a lot of sort of autonomy in how he fulfilled his role. So he could do it in the way in which he chose, how he dictated. So whilst actually on balance, so on one side, you had mutuality obligations and the control, that's employment, but he was in business on his own account and he could do it essentially how he wanted. And actually through the courts, Stuart Barnes won, he was treated as being self-employed under this. And again, I think if you're sat down and trying to work this out on your own without professional support, you know, you could, I think you can argue it both ways. So again, it just sort of goes to show and illustrate that it's not quite as straightforward as it might seem. Another case is the Eamon Holmes case. So that's gone through the courts twice. This one, again, upon my reading, seems a bit more black and white. Essentially, the first tier tribunal ruled some time ago now that he was inside IR35, i.e. his personal service company, which is called Red, White and Green Limited, was essentially, you know, he was essentially an employee, so should be taxed as an employee. He didn't like the answer to that, so he went up to the next court, which is called the upper tribunal. But from what I can tell, I mean, he seemed to lose everything. He had no rights to substitution. He had to accept everything that was given to him. He had no control over what he did or how he did it. He had none of the usual business features, i.e. didn't have like other clients or contracts in place. I think in this case, ITV even provided with a car, driver, clothing, insurance. They even did his invoices for him. And this went on for around 15 years. So I think on this one's a bit more black and white. That clearly, yeah, I think he had an employment relationship there. But it just goes to show that the fact that this was going on for 15 years, I think it's just demonstrated how poorly HMRC have been able to police these rules in recent years, which is again why we're seeing the change in it being the end user having to identify, you know, the nature of the relationship. So if we take the rules how they are now, because obviously Eamon Holmes's main client was ITV, they would fall in the medium to large category almost undoubtedly. So now it would be them who would have to make that determination rather than Red, White and Green Limited. And again, it'd been interesting to see how they would have considered that employment relationship, because again, the risk would have been on them had it gone wrong. Another recent case was that as Gary Lineker. I won't read through all this detail here, but essentially this one was a little bit different. So Gary was operating, rather than as a sole trader, i.e. just on his own, he was operating through a partnership. And what happened here is when this partnership entered into contracts with clients, rather than just Gary signing it, him and his wife, as partners of the partnership, both signed those agreements. And so essentially from this, it just meant that this is how they won the case. That if it just been Gary signing his own contracts and that was it, he would have lost this case, almost undoubtedly. But because it was a partnership, it was husband and wife both signing them, and it was just very much, you know, he can't be treated as being contracting directly with the organisations. Can't be, you know, he's not directly contracted with BBC or BT Sports. It's the partnership itself, because both signatures on that piece of paper. Which again, it's a very sort of brief summary of that, but just goes to show how important actually the paperwork is, because quite often contracts are looked through, but in this case, this was the part that, you know, they couldn't really do anything about. It's particularly unusual, firstly, because it involved a partnership rather than just having a sole trader. And actually, when you look at the detail of it, there wasn't really any loss of tax, because all it was really looking at was, you know, he'd already paid income tax under the partnership rules, which are very similar to income tax under the sort of sole trader rules. The only difference is he might not have had quite so much profit as if he'd done it on his own, because obviously he had a wife to have to share it with. So there was a small amount of national insurance at stake, as I understand it. However, this one's still a little bit up in the air, because HMRC still have the right to appeal this, so we may well see more of this one in the future. And finally, again, this is quite an old case, but I wanted to mention it, was the case of Lorraine Kelly. So she was the host of the ITV show called Lorraine, so clearly, you know, very connected to her, quite difficult. So on this basis, HMRC sought to tax her as an employee, because she couldn't, how could she provide a substitute? She didn't have, you know, she didn't have the final say. It was ITV who were the ones who could say, actually, you're going on holiday, we get to say who's, you know, we get the final say in who the substitute is. I think this was going through the courts. It came out as, I think initially it's a bit of a surprise to some people, because, like, you know, the substitution point is something that HMRC and the courts have focused on so much over the years, that actually, given that she won on this point, was actually a bit of a turning point in terms of the court cases here. And the reason she beat HMRC in court in the end over the use of the substitute was because overall what she was doing, she controlled what she was doing and how she did it. And also, while she didn't have the final say in that substitute, she was still the one going out there and identifying, you know, potential substitute presenters when she was on holiday or sick. So again, it just goes to show that whilst one factor could be the determining factor in so many sort of situations, that how a case like this actually can change the tide a little bit. And what we have seen is that, you know, the way people view this now is slightly differently. So, and that goes back to the point we said earlier about how, if with a substitute, it's about the right to provide one, necessarily about the going ahead and actually doing so. So it's just from a very geeky point of view, from my side, being a tax advisor, I find it really interesting. However, you know, you may not agree. I think next we want to talk about some myths.
Yeah, so I'll pick up the first one. So one of the big myths that we see, or questions that we see, is I can use the bank account as if it were my personal bank account. So this is if you've set up a limited company and you've got a business bank account. So this would involve taking money out of the bank account without taking dividends and declaring the dividends on your tax return, or the money coming out through the payroll. So if you were to do that, you'd end up with what we call a director's loan account in your accounts. And that is, where you've taken the money out and then it sits on your balance sheet as money that you then owe the company back, because it hasn't been declared through dividends or through the payroll. Now, HMRC don't like this, because you've taken money and put it into your personal account and you haven't paid any tax on that. So there's a couple of areas to consider. So in regards to the company, so HMRC will charge the company tax on this balance at 33.75%. So the company has to pay that tax on the corporation tax return, and it would get filed at the same time as your profits on your business. So if we have a look at an example then, so say you take £100,000 out of the company bank account, and this isn't declared through the payroll or dividends, then the company would pay the 33.75% tax over to HMRC. So £33,750 that would come out of the company bank account and get paid over to HMRC. And this tax is called S455 tax, which, as I mentioned, is submitted on your tax return and paid at the same time as your corporation tax. However, there's a couple of rules around this. So for example, at your year end, so let's say 31st of March 2023, if you had £100,000 that you'd taken out, if you repay that balance within 9 months of the year end, so by the 31st of December 2023, then you wouldn't have to pay that tax. So there'd be no S455 tax payable. Say, for example, you didn't repay the balance by 9 months and the company pays the S455 tax, HMRC will only pay that back to the company once you've repaid the £100,000. So that can take time for that to come back. So we always recommend that those directors' loan accounts are cleared down by the year end, because there are tax implications to having those. Now, there's also potentially a benefit in kind as well on that loan balance. So here we use the example of £100,000. If you do take over £10,000 out of the company bank account and have a director's loan account of over £10,000, then HMRC see this as a benefit in kind. So there's kind of two options available, is that that's declared on your P11D and tax is paid on that benefit, or interest is charged on the loan account. So interest is basically payable to the company from you, so your loan balance would increase and the company's owed that extra money on the interest. Now, the interest is kind of set by HMRC, the government, and there's kind of an official rate. So if, for example, you do charge interest on the £100,000 at the official rate, then you wouldn't have to put anything on the P11D. If you charge it at a so let's say that's 2%. If you charge it at a lower percent of 1%, then the difference between the 2% and the 1% would have to go on your P11D as a benefit. So there's just a couple of things to think about. If you are taking money out of the company, there are tax implications of that, and we try and advise clients not to take money out unless they really need to.
Yeah, definitely. And I think sort of as Jenny was saying, it's so important that if you do go down the corporate sort of structure for your trading, just please remember that your company is separate to you. It's not an extension of you, it's not part of you, because this is where we see clients getting tangled up and then get with all sorts of unintended tax consequences, which actually can be quite painful and costly to unwind. And so the first thing I always say to clients, if you're going to set up a company, make sure that company has a separate bank account and you do not touch it unless you've spoken to your accountant first and you understand what the implications are of you taking money out of that account, just to make sure it's structured in the right way. You're not catching any of the Section 455 taxes or any of the other sort of horrible sort of nasties that can lurk. One of the other sort of things we get again as a common misconception is that if I operate as a sole trader, I can reclaim all of my travel costs, and unfortunately that's not the case. So as a sole trader, again, it depends what you're doing. So as a sole trader, you may have a regular workplace that you go to, whether it's an office you decide to base yourself from, or whatever you might do. If it's basically regular commuting, i.e. you are traveling there every day as part of your role, even if you are self-employed, you can't claim your travel costs, in the same way as if I was as an employee, we can't go and claim what we've got as, traveling my train from here, say to London every day. I can't claim that because it's normal commuting. So, and again, it's a very common misconception because it's assumed that as a sole trader, you can claim everything, and you can't. Of course, if you're traveling, to ad hoc meetings or sort of other things, then there are parts you can claim. But again, it's just worthwhile keeping all of your records and just making sure that whether you think you can claim or not, if you've got a record of it, then when it comes to doing your year-end tax filings or your year-end sort of interest expenditure account, give that to your accountant or have a look through it and try and work out what you can and can't claim. Because again, there will be stuff you can claim, but you can't claim it all, unfortunately. The next one is about taking your clients out for lavish meals and getting a tax deduction. This is, again, probably one of the biggest kickbacks sometimes we get from clients when you've done a tax return, they're always entertaining, they've gone out and taken, whether it's prospective clients, existing clients, go out for a nice meal, we've made an adjustment in a tax return and say, oh no, that can't be a tax deduction. And that's probably one of the time people get the most disgruntled. And unfortunately, those are just the rules, taking clients or customers out. Just, you can't get tax deduction free. You can't get tax deduction free if you do it in the company or as a self-employed person. It's just one of those. Where there's a slightly more grey area, arguably, I guess, is where you're getting some sort of benefit for the trade on that. Like if there's some sort of advertising there, and it kind of the sort of the entertainment part is kind of incidental to the main part of it. But again, for the most part, you won't get a tax deduction for that. I don't know if there's anything you want to add there, Jenny, from what you see from your clients.
Yeah, I think a lot of clients are quite shocked sometimes if they're not aware of that rule, in regards to client entertaining being 100% not deductible.
Yeah, I think, but what's worth remembering actually, if you've got any sort of staff members or employees, an element that will be tax deductible. So it's slightly different rules, but you just need to be aware that you can only take your sort of staff members out, spend a certain amount of money on them per year before it then becomes a taxable benefit on them. So again, there's a bit more freedom on the side when it comes to actually, the sort of the welfare and well-being of your employees. And actually, it's probably one of my favourite ones that I had. It was a long time ago. I remember I had a run-in with when I used to be back in the days when I actually used to be in the audit team. Had a run-in with a client saying, "Well, my contract says this, therefore this must apply." It's like, unfortunately not. So misconception is, if my contract says this, then I don't have to worry about R35. Look, if my contract says I'm not employed, how can I be? How can HMRC consider me to be employed? And unfortunately, if these rules, are potentially in point, or there's any doubt over them, and it gets to the point where HMRC or other individuals are looking at that contract, whilst what the contract says is important, it's actually how the contract's implemented and actually what happens in the real world is actually the most important thing. So it's just worthwhile being aware that just because you put a contract in place that says you're not an employee doesn't mean if everything else suggests you are an employee, then HMRC will just look straight through that contract, and for all intents and purposes, it's not worth the paper it's written on. So it's just worth being aware of that.
Okay, right, and then I think we're on to the last slide. So if there's any questions, I know we've had a couple of questions pop up in the question and answer boxes, but if anyone has anything else, just pop it in there and we'll answer that now. So I think the first one, Michelle, do you want to?
Yeah, that's fine. I'll take that. It's about retainers. So yeah, I'm assuming then for this point, because if you're self-employed, so as we mentioned that, yeah, you're right, the IR35 doesn't apply to sort of sole traders, but instead you've got the employment status test to look at. So if you're receiving retainers, then it depends actually to the extent of what that is. So if you're receiving an amount, say every month, every quarter, which is essentially the same as a salary, and you're expected to provide the services of what an employee would do providing that salary, then the retainer is likely to take you into an employment relationship. But for the most part, if you're receiving a retainer, it's a genuine retainer, an organisation can call upon your expertise, whether that's some consulting advice or whatever it may be, and they say they're effectively buying a number of hours per month, per quarter, whatever, then generally they're absolutely fine. And, if it's regular and you're getting more than you are probably giving them back, then that probably leans slightly more towards an employment relationship, but not always, because they will look at the whole piece as to how that's being done. So whilst a retainer may well mean you have to, prioritize one client over another because they've said, well, we've bought this amount of your time, you have to give us that every month. That's absolutely fine, provided what you're doing around, everything else is not an employment relationship. And again, they'll look at, if you've got one retainer relationship and that's it, you have no other clients, nothing else whatsoever, then again, that probably leans more towards an employment engagement. Whereas if you've got several retainers or one retainer and lots of other projects ongoing, then again, that probably leans more towards being a self-employed. Again, it'd be on the balance of facts, but again, I wouldn't worry if you've got a retainer in place, that's going to cause you any problems in itself.
And then we've got a second one on there. That one's fine. And then there's one in relation to the client entertaining, but you pay this to the company. So how does that affect the account? So the client entertaining would come out of your account. So you'd have your income and then all your costs, so including your client entertaining, and then you'd arrive at a profit. So that profit would then go into your corporation tax return, but you would add back the client entertaining. So the cost of the entertaining comes out of your accounts, but it's non-deductible for tax. So we add it back on to your profit. So you actually pay tax on that client entertaining, but it still comes out of the costs of the company.
Yeah, it's one of those reasons why that when you come to pick up your, your corporation tax return at the end of the year, you'll look and see, well, I've been taxed on this profit, but that's not the profit in my accounts. And quite often those two numbers are different because of these kind of adjustments. So we have client entertainment as a common adjustment. Actually, if you've got like assets that you're using in your business, like normally you would depreciate those through your accounts. So again, in your profit and loss account, you have a depreciation number. Again, for tax purposes, you don't get a deduction for that. So what Jenny, would be doing, she'd be adding that back, so increasing your profits, but then would give you a slightly different allowance called a capital allowance to sort of reflect the sort of tax cost of it. So again, 9 times out of 10, if your profit per your accounts isn't the same as the profit you're paying tax on, whether it's actually your corporate tax return or even if your sole trade accounts, it's probably because there have been some tax adjustments in there. And unfortunately, client entertainment seems to be one of the more common ones.
And then we've got one, I'm wondering if LLP is the best option for me and my 2 partners. Any thoughts on LLPs are welcome. Can I ask, can you enter into a contract with a company as an LLP? So yes, you're set up as a limited liability partnership. So you'd enter into that contract with your client as your limited partnership. And you wouldn't, if you were a partnership, you would include your names on that contract. But the fact that you're a limited liability partnership, you would run as that limited partnership. So you wouldn't need to include your name. And yes, you can have a bank account with a limited liability partnership. We would expect, you would need to have a separate bank account as an LLP.
Yeah, LLPs are a bit of a funny one when it comes to, I suppose, the trying to get your head conceptually around it, because for tax purposes, it's treated as if you're just like a sole trader or or normal kind of partnership. But for intents and purposes, like it's a sort of bit more like a company in terms of how you report the profits, how you, what's on public record and everything else. But I think it's just, in the same way as an LLP would have a bank account and you'd enter into contracts with that LLP. Same way as you would do actually if you're an unincorporated partnership, and normally that would have its own bank account as well. And again, even if you're operating as a sole trader, we would always say if you've got a separate business, even as a sole trader, try to have a separate bank account for that business. Because firstly, it makes it very clear which money is yours and which money is that of the business, even if you take the sort of LLP or sole trader thing where you're paying tax as it goes. But actually, if you're getting an accountant to help you do the accounts, it actually should keep the costs down a bit, because what they're not having to do is go through all the transactions that actually don't relate to your business, which is a surprising thing that actually does increase costs when just dealing with year-end filings.
Okay. Next one is, could you explain depreciation? So say, for example, you have an asset that you've purchased in your company, and that's a laptop, let's say £500, sorry, £500 computer that you've purchased. Now you are planning on using that asset over a period of time. Let's say it's normally about 3 years for a computer. So you would capitalize that asset in your balance sheet because it's adding value to your business, but you're using it over 3 years. So you would depreciate that and release to your profit and loss over the 3 years, so that you're showing the use of that over the time that you're using the asset. And then it would have in the balance sheet every year, it would decrease by a third. And then by the end of those 3 years, you would have no value left on that asset on your balance sheet. So hopefully that explains depreciation a little bit.
Right, the next question is, I have a limited company and earn below the VAT threshold. Do I need to collect receipts? I don't currently, and my accountant's fine with this, but I know peers who do. I suppose me and Jenny can probably both take that question, but from my perspective, in terms of the tax world, So the reason it's a good idea to keep receipts is that if HMRC ever query why you are, claiming a deduction for something and ask for evidence that you've actually paid it, quite honestly, a receipt is the easiest way to deal with that if you've got that record keeping. Everyone's got their own business, should be keeping, appropriate accounting records, and that normally does include receipts. But I appreciate that sometimes when it's doing your sort of like slightly smaller scale, or everything's a bit more ad hoc, sometimes the keeping those bits of paper can be quite difficult. But again, I would say don't necessarily need to collect them. Ideally, try to. It's better it's better to have them than not. If you have none, an HMRC query, they would question, probably have a few questions for you as to why you're not maintaining adequate and appropriate records.
Yeah, and I think from a kind of accounting point of view, mixed with the tax, I think it's good in case your accountant queries anything, and they can have a look at those invoices as well. And keeping records is quite a good kind of habit to get into. And there are kind of options out there in regards to having apps that can take photos and then pull those photos of the receipts and pull those into your accounting system. So there are options to make it easier, because I understand having receipts is hanging around is it's easy to lose them. So if you can take a photo when you have that receipt and then it's in your accounting system, there are those sort of options around. Next one was just, can you think of any negatives to having an LLP as a small company not making huge profits then?
I'm not sure I quite understand the question.
Yeah, you might have to explain that one a bit more, Jess.
I mean, whilst we sort of wait for some expansion, so an LLP versus having a small company, I mean, to be honest, the reporting obligations are very similar. The one benefit of having an LLP versus a company is because an LLP has members and you've got partners that go in and out. It's a lot easier to introduce new people into that and take people out than it is with a company where you've got shares that have to be issued. And again, it's a lot more straightforward from a tax perspective to introduce people to an LLP and take them out than it is from a company, because those shares are a physical thing they actually hold. I don't think that's probably what your question was. But again, for LLP versus small company, so an LLP, you will pay tax as if you're a sole trader. So you pay tax on all the profits as and when they arise. So again, whether or not you're taking them out of the business is irrelevant, you're still paying tax. Whereas with a company, you only pay tax, well, the company will pay tax when you only pay tax on stuff you extract. So different trading structures work for different businesses. You tend to find it's professional organizations such as accountants, solicitors, and sort of surveyors who will operate as an LLP quite often because there's a turnover of people who are sort of heading up that business. Whereas with a company, you tend to see that for more organizations because it tends to be, you or family members or people you started your business with, and that remains fairly static. That's sort of quite commonly why those structures tend to be there.
I think that's it from the questions. So if anyone doesn't have any other questions, I think we're done. So thank you so much for everyone joining today. And we will be sharing the webinar with you, so you'll have a copy of that to refer back to if you need to. But hopefully that's been helpful for all of you.
Yeah, but should you need anything, got any follow-up questions, please do get in touch with me or Jenny. I'll be happy to come back to you, because I appreciate sometimes with this kind of thing, we throw a lot of information at you and it might just be later on that you have a chance to think about it, need a bit of clarifications. So please do reach out if there's anything like that.
Yes, definitely. Great. Thank you, everyone.
Thank you. Enjoy the rest of your day.
Bye.